April 2024, question number 3. April 2024, question number 3. Yeah, remember this class is starting at 7, it has already begun, and we shall finish at 8:30. 8:30. Yeah, at least somebody has been able to get this. Maggie, thank you. So I believe Maggie has shared it on WhatsApp, and I hereby read this. You shall always start by reading the requirement. So the requirement, we are told in this case here required of this question, they want us to give them the offer price for small limited, assuming Duet Limited chooses to value small limited on a forward price earnings multiple of 8 times. Number 2, the cost of capital of Duet Limited. Number 3, determine the offer price for small limited using discounted free cash flow valuation method. So you're told April 2024, we are told up there, Duet Limited is considering a takeover bid, for small limited, another company in the same industry. Small limited is expected to have earnings next year of 129 million. If Duet Limited acquires small limited, the expected results from small limited will be as follows. So we have years 1, 2, 3, sales, cash expenses, capital allowances, interest charges, cash flows to replace assets and finance growth. Additional information from years 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. Note 2, tax is payable at the rate of 30%. Tax is paid in the same year it falls due. They have not told us that tax is paid 1 year in arrears. If they tell us tax is paid 1 year in arrears, it means that the tax for this year has to be staggered and paid next year. So year 1 tax paid in year 2. At times that confuses very, very many students. So you're told here that if Duet Limited acquires small, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as proportion of total equity plus debt. The cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. The risk-free rate of return is 6%, and the return on the market portfolio is 11%. So they want us to use a funny method here called PE ratio method of valuation. The solution, Roman 1. So they want us to use PE ratio valuation method. PE ratio valuation method. PE ratio valuation method. PE ratio valuation method. So PE ratio valuation method, this is the easiest. PE stands for what? PE stands for price earnings ratio. Price earnings ratio. Price earnings ratio. Is there somebody who can help Mwalimu with the formula of getting PE ratio? Anybody who is able to give me the formula of getting PE ratio? PE ratio will be equal to what divided by what? You can see there is an over there. So PE ratio will be equal to what divided by what? PE ratio will be equal to what divided by what? Thank you so much. We are being told here, it is price of earnings. So it is MPS over EPS like that. It is MPS over EPS. And because they want us to value an organization, then make MPS the subject of the formula. Make MPS the subject. Make MPS the subject of the formula, yes. So try in this case here, multiplying both sides by EPS to be left with the MPS alone. So MPS will be PE ratio times EPS, like that. So to get MPS, you take, in this case here, MPS equals PE ratio times EPS. All right. All right. So, ladies and gentlemen, then, remember this will be value of a share. Value of a share. And we want total farm value. So to get total farm value using this approach, total farm value using this approach, I will take the PE ratio times total earnings. PE ratio times total earnings. So see now, we're looking for total farm value. Yeah, following this approach, PE ratio will always remain the same. But now here, we shall talk of total earnings. Because I'm basically taking this market price per share multiplied by all shares, multiplied by number of shares. So if I multiply this by number of shares and this by number of shares, here I will be getting total farm value, and here I'll be getting total earnings, like that. So like in this question, they have given us the PE ratio expected forward in future PE ratio expected is 8, and they have given me the earnings I'm going to get from this organization that I'm acquiring. The earnings I'll be getting from this organization that I'm acquiring. How much do we expect to get? If you read this question from the very beginning, first paragraph, Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Which company? Small Limited. Is expected to have earnings next year of 129 million. Yeah, of 129 million. And then in the required, the offer price for Small, assuming Duet Limited chooses to value Small Limited on a forward price earnings PE ratio of 8 times. 8 times of the total earnings. It's very easy to value this organization using PE ratio method, because you take the PE, in this case here, times the total earnings. So total earnings, ladies and gentlemen, what do we have here? 129 million. Quite a huge organization. Then how much shall we end up getting, ladies and gentlemen? 8 times 129 million. How much shall we end up getting here? Yeah, thanks, Julius. Yeah, 8 times 129 million. So you basically take the total earnings of the farm times PE ratio. You don't have to do all these derivations. I've done these derivations just for proving a concept. Otherwise, in an exam, you shall always know that total farm value equals PE ratio. You take the earnings given. The earnings given times the PE ratio. I'm being given a very huge figure by Maggie here, 1032 million. 1032 million. So this is 1032 million. A billion. Yeah, thank you so much. That is the farm value. So when we get to the negotiating table, already we know that our farm is valued this much. So there is no way the predator will give us anything less than this. Of course, this is business. They may bargain. But they can't do a bargain of more than 10%. No. At least we are going into these negotiations having known this value. Now from there, ladies and gentlemen, we shall go to Roman number 2, where they want us to give them the cost of capital of Duet Limited. Cost of capital of Duet Limited. Where they want us to give them cost of capital of Duet Limited. Cost of capital of Duet Limited. Cost of capital of Duet Limited. So cost of capital Duet Limited. So cost of capital of Duet Limited. Now, remember, we have 2 major components of cost of capital. So we have what we call cost of equity and the cost of debt. There are 2 major cost of capital. I mean, let me first of all start by reminding you that the 2 major classes of capital, we shall have, for example, Aura is starting in this case here, college known as the RCM here, right? So we need this particular capital to be able to put up our great buildings for our offices of the RCM Open University. So then if Aura has some savings, say 100 million, then I'll be able to put that 100 million into this. Yeah. owner's contribution is what we call equity. And of course, 100 million or this owner's equity may not be enough. Perhaps in this case here, the great offices need 300 million. So we need, in this case here, an outsider, someone else who will be able to put in the 200 million. So you can see my capital will be having two components. We have the equity, owner's contribution, and then we have the debt capital. All right. So in this case here, whenever the examiner asks you to calculate the cost of capital, always remember what we call the weighted average cost of capital. Weighted, always remember this weighted average cost of capital. Always, you should remember that. Yeah, so the weighted, now you combine the two, cost of equity and the cost of debt. So we have here our WACC, what we call WACC. Our WACC will be equal to weight of equity, cost of equity, weight of debt, cost of debt, adjusted for taxation. Yeah, remember, this KE stands for cost of equity. Cost of equity is dividends, and dividends can never be allowed for taxation. When you do your income statement, you can't say profit before dividends and tax, and then you less dividends to get profit before tax. Not possible. Dividends are appropriations to the owners. Appropriations. So this is never tax allowable, and that is why we don't put here into 1 minus t. No. Remember, KD is cost of debt. Which basically is interest. You and I, of course, know the fact that interest is normally allowed for tax purposes. That's why you're saying here, KD, cost of debt after taxation, like that. And then we have WE. WE stands for weight of equity. WD stands for weight of debt. Yeah. Weight of debt is also known as gearing ratio. And remember how we normally get weight of debt? We take the debt amount all over the total capital structure. Yeah, you take debt all over debt plus equity. Like the example that I gave you, Aura here, who is the owner of RCM, of course, I'm giving as an example. So in this case here, I gave 100, and then the debt holders, I've given you 200. Yeah, so don't write this, it's just for your eyes. So in this case here, to get weight of debt, we are taking debt over debt plus equity. So debt is 200 over 200 plus equity of what here? 100. Yeah, something like that. Which will end up giving you 0.333. Yeah, if weight of debt is 0.33, what will be the value of weight of equity? What will be the value of weight of equity here? If the weight of debt, no, this is 0.6, sorry, 0.67, sorry, 0.67, because it is 2 over 3. It is 2 over 3, 0.67, and then weight of equity will be equal to what, ladies and gentlemen? Please help me. Weight of equity will be equal to what, ladies and gentlemen? Yeah, because you see, the 2 must add up to 1. So then weight of equity will be 1 minus 0.67, which gives us 0.33 like that. I don't want you to write this. I just wanted to give you some demonstration here. Now, ladies and gentlemen, at this level, unlike in this case here, the financial management of the intermediate level, here the examiner will never give you KE directly. The examiner would want you to get KE. And in most cases, the examiner would want you to get KE using KPM. So get KE, cost of equity, using KPM. Cost of equity using what here? Using KPM. Is there somebody who could be knowing what KPM stands for in full? KPM is an acronym. Is there somebody who could be knowing what KPM stands for in full? Yeah, get cost of equity using KASNEB, KASNEB. Very, yeah. So KASNEB in this capital assets pricing model, all right? So in this case here, capital assets pricing model. That model in this case that tells us that your capital assets should be equal to risky assets plus risk-free assets. Capital assets, remember capital assets. Capital assets will always be equal to risk-free assets, risk-free assets plus risk-free assets plus our risky assets. Risky assets. But if you're a rich man will never just have risky assets alone. A rich man will always combine risk-free and risky assets. I can tell you, ladies and gentlemen, without in this case here missing any words, it doesn't matter the vehicle you're driving. It doesn't matter how many shares of Safaricom you have. If you don't have government securities within your rich portfolio, then automatically you are never rich. Something can happen. Remember, government securities are normally risk-free. They are normally secured, right? And we will tell you something about this. But whenever we talk of capital assets, ladies and gentlemen, and then somebody tells you, hey, give us KASNEB, cost of equity. How do we get this KASNEB cost of equity? We shall always start with the risk-free rate because we have these risky-free assets. So risk-free rate plus, in this case here, the market returns, what we call ERM. So ERM minus risk-free to get what we call risk premium. So you see, these are the risky assets. Risky assets, of course, in this case, they will give you a higher return. They will always give you a higher return. But the risk in this case is also high. So you take away risk-free from risk, or rather, the market returns. Yeah, the market returns. When you take away risk-free from the market returns, you get what we call risk premium. And this risk premium now has to be multiplied with what we call beta what here, with what we call beta equity, Beta equity. Yeah, please, for the sake of those students who did their financial management long time ago, just allow ourselves there to remind them the meaning of this. So this is risk-free rate. Yeah, then we have RM is returns of market portfolio. Yeah, remember this E, you can even omit it from the formula. It stands for expected returns of the market. Yeah, then we have a PE. PE is beta equity. Beta equity. Yeah, beta equity. And then remember that this beta is a measure of, it is a measure of systematic, risk. It is a measure of systematic risk, i.e. the risk that exists in all sectors. Yeah, it cannot be reduced. It cannot be reduced. It is systematic. It cannot be reduced. You know, we have risks, ladies and gentlemen, that you can easily run away from. Assuming, for example, I'm among those people who don't love how foreign currencies keep on fluctuating. I don't love the forex risk. Yeah, foreign exchange risk. I don't love it. Then I will just do business like what we do at RCM. All right. At RCM, in this case, we don't receive any foreign currencies. All right. Even the students that we have here from Rwanda, from Southern Sudan, ladies and gentlemen, at the end of the day, what do? We tell them to change their currencies and they give us Kenya shillings. So we are running away from foreign exchange risk. So then I will avoid investing in companies that are involved in importation and exportation. I'll not invest there. So you see, ladies and gentlemen, now this foreign exchange risk is unsystematic. It doesn't apply to all sectors of an economy. Unsystematic doesn't apply to all sectors of an economy. But there are those risks now that exist everywhere. Every sector you go to, you always find them. We are calling them what is systematic risks. Systematic risk. And now the measure of this systematic risk is what we are calling beta. Is what we are calling beta risk is the same as what is systematic risk. Is the same as systematic risk. So then in this question, have they given me in this question, have they given me risk-free rate of return? Oh, yes, they have done that. If you look at, note number 5. Note number 5, they are telling me note number 5, the risk-free rate of return is 6%. 6%. So risk-free rate of return is 6%. 6%. Risk-free. Risk-free is 6%, and the return on the market portfolio is 11%. So this market portfolio return is 11% minus our risk-free of 6%. Look for something they always give you this beta, and even if they don't give it to you, later on when we advance to other topics, I'll be showing you how do we calculate this beta equity. Yeah, because at times they may want to confuse you. Instead of giving you beta equity, they give you what we call asset beta. When they give you asset beta later on, in portfolio theory, we shall be teaching you how to convert some betas using a very famous model that never misses in your exams, what we call the Hamada's model. What we call the Hamada's model. But in this question, we were lucky because they gave us beta equity. If you look at note number 4, they've told us note 4. The cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. Those words can be used, of course, interchangeably in time. It's either equity beta or beta equity times 1.6. All of us, ladies and gentlemen, if we are proactive, let's provide the final answer here. All of us must pick our calculators. So it is 6 plus 11. You must put brackets here. Minus 6. You close. Times 1.6. As I'm punching, I don't have to put those percentages. As I'm punching this in my calculator, I don't have to put those percentages. I don't have to push those percentages here. 14%. Thank you so much. 14%. Now we have forgotten this, but remember, at the end of the day, we want to get Wakaka. To get Wakaka, I need the weights. Most importantly, I need the weight of debt. Weight of debt is my WD. This is the gearing ratio. The gearing ratio, which in a particular note here, they've told me, if you look at note 3, if Duet Limited acquires small limited, note 3, if Duet Limited acquires small limited, it estimates that the gearing after acquisition will be 35%, measured as the value of debt capital as a proportion of its total equity plus debt. So in short, they're telling me that the gearing ratio is 0.35. So I have WD. Then how about WE, weight of equity? So this will be 1 minus weight of debt, which will be 0.65. 0.65. So up to here, ladies and gentlemen, are we together somehow? Somehow it can't be like 100%, because you know it's also quite circumstantial. As I always keep on telling you, I'm 100% sure there must be a ninja who is deeply sleeping, but fortunately, they're still having their mobile phones on, pretending to be in class, but I mean, it's much better than not attending at all. I thank you for that. There must be a ninja like that. There must be another ninja mwenye sasa anakula. Very early in the morning, na anapenda kula ugali. Anakula ugali, na anakula ile kitu ambayo tumia kijiko. Unajua kutumia kitu ya kijiko ni better sababu unaandika kidogo. Unapata in this case anakula ugali, hata samaki. Na anaweka class wapi? Naendelea namna hii. Yeah, now when I come back to hapa kando, so it can't be like 100%, but are you able to follow, ladies and gentlemen, somehow? Somehow, I'm so sure there must be a ninja like that. I'm 100% sure. The only thing we allow you to drink when you are doing these studies, just a cup of coffee, yeah? Cup of coffee without milk. Yeah, black cup of coffee without milk. We shall overcome. Geoffrey, I hope you're not eating anything. So remember, we want in this case here to get WACC. WACC, which is WACCA. WACCA is weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus taxation like that. Fortunately, we have the weights here. So weight of equity is 0.65. Cost of equity that we ascertained using KPM is 14%. Plus weight of debt is 0.35 times cost of debt. Cost of debt that has been given to us, 7.4%. Note number 4, the cost of debt is 7.4% before tax. 7.4% before, so 1 minus tax is 30%. 1 minus tax, which is 30%. Great. Now again, everybody, even if you're sleeping, please get out and get your calculator. Just try that. That can help you to wake up. So 0.65 times 14 plus 0.35 times 7.4 times 0.7. Because you see 1 minus 0.3 is 0.7. What are we getting at the end of the day? Yeah, so Caroline has given me a figure of 10.913. So this is 10.913%, which is the same as 11%. So this is what we shall use as our cost of capital. This is what we shall use as our cost of capital. This is what we shall use as our cost of capital. This is what we shall use as our cost of capital. So, ladies and gentlemen, up to here, are we okay on how we have been able to derive WACCA? Are we okay on how we've been able to derive WACCA? Yeah, this is really, really important. Thank you so much. So then I can continue. All right. Thank you so much. Now, ladies and gentlemen, from there, they want us to do something called offer price valuation. We're going back to valuation, where they want us to determine the offer price for small limited using discounted free cash flow valuation method. April 2024 is what we're doing. Yeah? So April 2024, question number 3B. Question number 3B. And by the way, tomorrow is a holiday. Yeah, I forgot to make an announcement. I always like getting something to keep me free. Yeah, to keep me busy. I don't want to be free. Yeah, idleness is the devil of what here? The workshop of the devil. I don't want to be idle. So are we able to create a class, a quick class tomorrow? And if yes, what is the best time? And if yes, what is the best time? I'm just free like the whole day because I haven't fixed even any other class. Yeah, it's good to talk about this so that you guys now can go to WhatsApp group. You say, even tomorrow we have early morning, the better, right? Same time, same at 7 a.m. Yeah, for just 1.5 hours, we tackle like 2 questions, then that will be very good. That will be very good. That will be very good. Thank you very much for giving me what to do. Thank you very much for giving me what to do. I like being very busy. So they want me to use free cash flow method. So free cash flows, first of all, I have to ascertain profits. Yeah. How do we get profits? We take revenues, accountants, we subtract all costs. So first of all, you have to derive this thing up to PAT. Derive it up to PAT. So then I can see the firm that you want to acquire Duet on paragraph 2. They are telling us if Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. Isaiah wants us to do it at 8. Isaiah would want to sleep for 1 hour. But we can discuss about that on WhatsApp. Don't worry, we'll be able to pick this on WhatsApp. But thanks very much. All right. So you see the firm that we want to value is the firm whose cash flows we want. And how do we get cash flow? Cash flow basically has got every relationship with profits. So no worries. So now I'm calculating my profit. So we have here year 1, year 2, year 3. We can do our figures, all our figures in shillings, millions instead of thousands. Let's put them in millions. Yeah. So we start with sales revenue. Sales revenue. Sales revenue. So sales revenue is 300. Sales revenue is 300. We have here 420, and then we have here 480. That's sales revenue less all expenses. The first expenditure there is what they're calling cash expenses. Yeah, I've decided to chop those 3 zeros to make them in millions. So the cash expenses, we have 180, 180, 180, 240, 180, 240, 180, 240, 270. Yeah, like that, like that. Cash expenses. From there, we have capital allowances. In financial management, we don't call them capital allowances. You can just write for the sake of it. In financial management, we call this depreciation. Yeah, to avoid confusion, we normally call this depreciation. Yeah, great. I can see in this case here that is gaining momentum. Because somebody wants us to do 3 hours. If we can do 3 hours, perfect. After that, I'll be very tired, very happy, which is very, very good. Very good. But very few students can withstand 3 hours. Very few students can withstand 3 hours. We shall just do 1.5 hours. 1.5 hours is normally optimal because of so many reasons. There are young mothers here. You get somebody who has a kid of 3 months. Yeah, you know, people multitask a lot, by the way. And that's why I respect CPA students. And they multitask a lot. So keeping this individual for 3 consecutive hours, it becomes an international disaster. Just 1.5 hours, I'm okay. I'll go to another class. So depreciation, we have here 30, 45, and 60. So we have here 30, 45, and then 60. Like that. I'm just subtracting all costs. I'm subtracting all costs. We have here interest. Sometimes they use the word finance cost. Yeah. So the interest charges, we have 15, 15, 15. Yeah. So, ladies and gentlemen, the next one is cash flows to replace assets and finance growth. Is that a cost? Is that an expenditure that we should be able to deduct from here? That cash required here to replace assets. Cash flow required to replace assets. Is it a cash that I should be able to? No. That one will be able to help us when we are calculating the free cash flows, right? Because that is what we call CapEx, capital expenditure for future expansion. That is cash withheld within the organization. Yeah, it's cash withheld within the organization. So that is it. So come here and they give us our profit here before we share with the taxman. So profit before tax. So profit before tax, simply subtract profit before tax. Simply subtract. So 300 minus 180 minus 30 minus 15. $75. $75, the first one. Here 2, we have 420 minus 240 minus 45 minus 15. Brian, it will not be an expense. It will not be an expense. I'm going to show you how we apply it. Yeah, you know, the moment you expense it, it means that you're subject to taxation. No. So we have here 120, and then lastly, year 3. Year 3, lastly, is it 120 as well? 135. So please go ahead and share this with the taxman. You are a good, faithful servant. Yeah, share this with the taxman. Tax at 30%. So knock these numbers with 0.3. Knock these numbers with 0.3. With 0.3. Knock the numbers here with 0.3. Give me the answers. Thank you so much, Chalo. 22.5, the first one. 22.5, the first one. And then the second one, ladies and gentlemen, If you take 30% of this, 0.3 of 120, 0.3 of 120, 36. Thank you, Shayla. I remember Shayla very well. 36. All right. And then now we have the last one, 135 times 0.3, 40.5. I also remember Tony Mbudia. Yeah. So come here, give us here PAT, profit after tax. Profit after taxation. So you take the profit before tax, you less tax, you give us numbers, you give us answers there. Yeah, the first one is 52.5, 52.5, 52.5. Then we have in this case here 84. I'm being given a figure of 84. Thank you so much. Thank you so much. And then here 3, what do we have? 94.5. Now remember, whatever you have gotten, ladies and gentlemen, is not cash flow. You deducted some bad expenses. You deducted some non-monetary expenses. Yeah, you remember non-monetary expenses, in most cases, the examiner will give you amortization, depreciation, those two. So whenever you see them here, to make this to be cash flow, add back. So come here and add back depreciation the way it is. Don't do it like depreciation tax sheet. Remember, there are 2 methods. Let's just stick with this longer way. So add back depreciation the way it is. So we have here 30, 45, and then now we have 60, like that. So you're adding back. So for you to get what we call cash flows. Cash flows. Yeah, thank you so much, Maggie. Add back depreciation. This I can see is 82.5. 82.5. Great. 129, I'm being given a figure of 129. Thank you so much. And then lastly, 154 point something, 154.5. And then now remember, you cannot say that this cash is free to the new buyers of the business. The new buyers of the business will not be able to enjoy this cash the way it is. No, there is cash that is being withheld by the business. Any business will always want retentions. So in this case, you must come here and less capex. Less capex. Capex is capital expenditure. Or simply at times the examiner will use the name cash withheld. Cash withheld within business. Cash withheld in the business. So cash withheld in the business, that I can see a cash flows to replace assets and finance growth. I can see 37.5, 37.5. Then we have 45, Then we have, ladies and gentlemen, 52.5, 52.5. So subtract like that, you subtract like that, and then you come and give us what we call Mandela be free cash flows. Give us what we call free cash flows. Give us what we call the free cash flows. So free cash flows, so you take this minus this, give me an answer, I write. This minus this, give me an answer, I write. This minus this, give me an answer, I write. So the first one is 45. The first one is 45. The second one, 129 minus 45. 129 minus 45 is 84. Is 84. And then we have 154.5 minus 52.5, which is 102. Thank you so much. 102, like that. Great. So now we've been able to get what we call free cash flows. Once I get these free cash flows, I'll come and make them in columnar form. I will come and do a column of the same, a column of this. So we have here years 1, 2, 3. Then we have, of course, infinity. Yeah. So we have our free cash flows. So free cash flows, what do we have? We have here 45. We have 84. We have here 102. But now we need to get this infinite cash flow. We need to get this infinite cash flow. And I would want to give you a minute and see whether there is any student who will be able to give me this infinite cash flow figure correctly. Look at additional information number 1. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year in perpetuity. So I will give you exactly 3 minutes. You guys should be able to try giving me this figure. Try giving me this figure. Try giving me this figure. Yeah, it's called the Gachagwa's model, Arap-Machani. Yes, it's called the Gachagwa's model in finance. Even if you get Gachagua, you must just make yourself love him for this other to love you right back. Yeah. For the subject, for the sake of the subject. Because you will rarely get, in this case here, an AFM paper without these things of perpetuity in infinity. Yeah, so you must love this gentleman, not for politics, but for the sake of the subject. You know, there is somebody here who can't write the name Gachagua on their book. There must be somebody here. But for this particular exercise, please go ahead and do what here and write his name and the model. The model itself is known as dividend valuation model. And you know the father of my shares, you know the father of my dividends is Gachagua. Yeah. Dividend valuation model. You will get the examiner writing for you using DVM model. DVM, and then you'll get so many guys calling me after class, like, what does this DVM in this case now stand for? Dividend valuation model. Dividend valuation model. Mike, yeah, and then you'll never forget the formula. Yeah, you'll never forget the formula because Gachagua is the only man who talks about dividends. Yeah, dividend valuation model. All right. No worries, Nelly. Sorry for that. Yeah, next time you shall put an alarm and please ensure that when this alarm goes up, don't snooze it. If you try snoozing an alarm, you'll never wake up in this case here to do these things. Nevertheless, I'll be able to put it up. You know, like now, this small holiday, you can use it very, very well. I mean, like this week I'm aware of a holiday on Monday, a holiday on Friday. You can use this very, very well to study. Remember hata kwa Biblia walisema, sijui kwa Quran, walisema kwamba ufalme wa Mungu ni ufalme ya watoto wadogo. So lazima ujifanye katoi. Yeah, unajeka tu busy atakao uko tajiri aje atakao unafanya kazi gani. Hii holiday, make sure you maximize it fully. This is not that holiday unataka kupata man off. No. Jifanya mtu mdogo 2 months, upite kitu ikuondoke. Yeah, upite kitu ikuondoke. Yeah, thank you so much. You shall overcome. You'll be able to catch up. Yeah, perpetual cash flow. Julius should be able to get my present. Julius, this time round, I cannot run away from giving you this. Last time I ran away. Julius, please give me your number, Julius. Julius, give me your number, Julius. Julius has been able to apply. Julius, give me your number. I mean, last time I ran away from you because I've given you very many presents, but if you're keeping on getting now correct answers, what should I do as my son? I have to keep on motivating you. So 0717 630 304. Great. Thao moja hii holiday sio mbaya. Yeah. Yeah, great. Keep it up. All right. So the perpetual cash flow, this dividends man may be in government perpetually. You never know. He may be relevant. Not even being in government, but he may be relevant moving forward in Kenyan politics. Because him, he has been able to appreciate this concept of what, most of us suffer because we are not good with this. So he has been able to appreciate that public speaking, just like our president, public speaking, this is the greatest gift that all of us in this case should be able to work on for us to survive outside here. Yeah, we can't expect to survive outside here if, ladies and gentlemen, where you're supposed to be using the word she, you're using C. Yeah. Where you're supposed to be using L, you're using R. I'm the bridegroom. I'm not the bridegroom's brother. No. So those two gentlemen are very good in public speaking and they know how to play around with words. And because of that, then we are saying that provincial officer will always be equal to district officer into 1 plus what year growth rate. The DO grew. Ashago grew. He grew in this case, actually never even became the PO. He became in this case here, the MP, yeah, and deputy president like that. All right. And of course, in this case here, if we remove him from government, we shall be talking of Kenya without what here? Kenya without a government that is now so much confused. Yeah. If they left him even to be in government, I don't talk politics, but if you ask me, it would have been a better equal. He's not a very good man, but it would have been a better equal. So PO equals, provincial officer equals, district officer into 1 plus growth rate, all over Kenya minus government, Kenya without government. So remember, this PO stands for present value. Present value, which is the same as a current market price per share. Current market price per share. Yeah. DO in this case here stands for current dividends. Current dividends. The most current dividends. The most current. This KE stands for cost of equity. The one we computed. Cost of equity, the one that we computed. The one that we computed. But now, ladies and gentlemen, remember that this formula is used to value a share, one share like this. But this question here, we are valuing a farm. This question, we are valuing a whole farm that has got debt and equity. So to get the perpetual cash flow, what we normally do if you're valuing a whole organization is simply follow the model. So you take the most recent cash flow. Most recent cash flow, which has to grow. It has to grow. But now in terms of costing here, we can't use just cost of equity for farm valuation. For farm valuation, we shall use WACCA. For farm valuation, we shall use WACCA. Because our farm doesn't have just equity alone. It has got debt in it. So we shall use WACCA minus, in this case here, growth rate. Minus growth rate. Or don't touch the mountain. Okay. So perpetual cash flow. Perpetual infinity cash flow. Very, very important. So the most recent cash flow, our DO, from the information that we have here, the most recent cash flow is 102. So you take here 102 into 1 plus G is the perpetual growth rate, which is given note number 1 from year 4 onwards. From year 4 onwards, it is expected that the annual cash flows from small limited will increase by 4% each year. So that is the growth rate. So 0.04. Divided by our WACCA. Remember, our WACCA was 11%. Our WACCA was 11% minus 0.04. Minus 0.04. So here you have to really go slowly. Give me the numerator. I know the denominator will be 0.07. This one I know. This minus this I know. But how about the numerator? What is 102 times 1.04? What is 102 times 1.04? 15.43, right? Just want this top figure. 102 times 1.04. 102 times 1.04. Great. 106.08, right? So I'm being given 106.08. 106.08. So then can you kindly give me the total quotient? What number should I write here? What number should I write here? What number should I write here? When you divide the one that this gentleman gave us, the one that this gentleman gave us, is it 1515? Mwalimu had gotten it right. Oh, so Julius was wrong. So Julius, you must be lucky. Don't return the money. You are lucky. You are lucky. I'm being told it's 15, 15. 15, 15, right? So what we shall do, because Carol had also gotten it, so Carol will send me the number as well. Because Carol had gotten it right, so I blessed both of them, right? Yeah, 15.43. 15.43. 15.43. 15.43. So all of us are in agreement, ladies and gentlemen, with that number? All of us are in agreement with that number? All of us are in agreement with that number? All of us are in. Thank you so much. This number is correct. This number is pretty correct. Thank you so much. So, and Carol was the first one to get it right. Carol was the first one to get it right. Carol was the first one to get it right. Carol was the first one to get it right. Carol was the first one to get it right. Carol and Kamau, great. Lady from the mountain, great. So 15.43. 15.43. Oh, Julius used that exact 10.913, but remember we rounded off to 11%. No problem. No problem. Nobody can really give you a fail because of that. Those are rounding off errors. They are normal. Rounding off errors, they are normal. They are normal. They are very normal. All right, ladies and gentlemen, what do we do next? Now let's go ahead and discount these cash flows, because they are into the future cash flows. Discount them. So you can see they are irregular. If they're irregular, then we shall use what we call PVIF to discount. Remember PVIF, formula of getting present value interest factor. We say it is 1 plus R raised to negative n. 1 plus R raised to negative n. R Julius, for the sake of uniformity, let's use that 0.11. Yeah, so 1 plus 0.11 raised to negative n. So the first one will be 1.11 raised to negative 1, because n is the year. So we have here 1.11 raised to minus 2, 1.11 raised to minus 3. Yeah, so could you kindly give me these values? Here you will repeat the above. Here you will say 1.11 raised to minus 3, because you see this infinite. We normally repeat this. Yeah, great. So please give me these discounting factors. Give me these discounting factors pretty fast, ladies and gentlemen. What do we have there? Yeah, Julius gives me 0.9009. Thank you so much. That is the first one. So I hope everybody knows how to raise. So 1.1 raised to minus 2. 1.11, so 0.8116. 0.8116, abazungu alikosea, atasawa nataka kupronounce ati 0.8116. Africa 0.8116. 0.7362. 0.73 12. And here we shall always repeat the same. Yeah, 0.73 12. And then you come and give us the famous DCFs. So come here and give us the famous discounted cash flows. Give us the famous discounted cash flows. So we have here 45 times this, give me a number. 45 times this, give me a number. 45 times 0.9009. 40.54. So here we have 40.54. And then we have 84 times 0.8116. 84 times 0.8116. 68.17. 68.17. Then we have here 102 times 0.73. 12. 102 times 0.73. 68.17. No. 74.57. 74.57. And then we got the last one, which is now this times that. 1107.93. 1107.93. Please add up everything. Whatever you get here will be the farm value. Add up everything. Whatever you get here will be the farm value. Farm value will be the farm value. Present value. Present value. Present value. Present value. So you add all the discounted cash flows and then you advise. Tell us whether we are good to go. Tell us whether we're good to go. Infinity, okay, great. Great. So 1291.21. 1291.21. Now you see, from the beginning of year 4, this figure began to grow indefinitely. And that was it, 4%? Yeah. So then we were able to discount it from the future up to the beginning of year 4. Up to the beginning of year 4. Beginning of year 4 is the same as the end of year 3. So this infinite, normally we share the same water discounting rate. You see, this figure was discounted up the beginning of year 4, and beginning of year 4 is the same as what year? End of year 3. Yeah, the same. So we normally share. After all, ladies and gentlemen, to get this infinity figure, we used this figure to derive it. We used 102 into 1 plus whatever g all over. So we have used this 102 figure to get this infinite cash flow. All right. And therefore, ladies and gentlemen, we shall be able to use the same discounting what here? The same discounting factors. Same discounting factors. So this lady called name. I don't know whether that's what you wanted me to answer, or you wanted me to pick it from here, that infinite cash flow is equal to the most current. Most current is 102 into 1 plus the perpetual growth rate. Perpetual growth rate was 4%, I think, or 0.04, like that. All over, in this case here, our WACCA, because it's farm valuation, it's not share valuation. So WACCA is 0.11 minus this is 0.04. Then you go slowly, get the numerator, denominator, and then you finish like that. Now, gentlemen, since we began these particular classes, I've never given you guys any exam. I think I should be able to give you an exam. I think I should be able to give you an exam today. I should be able to give you an exam today. Let's go to December 2022, question number 5C. December 2022, question number 5. December 2022, question number 5. No, Rosalind, it's not your calculator. It is not your calculator, Rosalind. Let's move slow here. It's not your calculator. Remember, it is 102 into 1 plus 0.0. Or is it for the total? Is it for the total? Is it for the total, Rosalind? The 1108. Is it your total present value? It cannot be like that. It cannot be like that. It cannot be like that. Sorry for that. Let's in this case here repeat. So remember, we have year 1. 1, 2, 3. And then we have infinite. Is there somebody who can remind Mwalimu in this case here what we got as discounted cash flows? Discounted cash flows very fast. Let's accommodate our sister here. Year 1, what was the discounted cash flow? Year 1. 40.54. So we have 40.54. Year 2, please. Year 2, please. 68.17. 68.17. Year 3. Year 3. 74.58. Thank you so much. Yeah, 74.58. And then we have the last one. Oh, Wesley is confirming 1107.93. Please, let's be very serious. Let's add ourselves, all of us. Thank you for bringing that morale up. Yeah, 1107.93. So Liaka wants me to repeat the final part. You need to specify Liaka. 1108 point. You've saved the situation, Rosaline. 1108. No, people are still saying it is 1291. People are still saying it is 1291. 1108.08. 1108. Well, 08 and the line 3 are the same. Stella is still insisting it is 12. Who can tell us? Where do you think in this case here are we wrong? My last discounted cash flow for year 4 was not right. It was not right. For year 4 wasn't right. For year 4 wasn't right. So let's get it right. So we have infinite cash flow 1 or 2 into 1 plus 0.04 all over 0.11 minus 0.04. Can you kindly first of all give me this alpha value, this infinite figure? Please give me this infinite figure. First of all, give me the infinite figure. The infinite figure. Yeah, round them off. And that's why I want us to be very, very 15.43. So 15.43. And then we have here PV. What is the PV for this? Is it 0.7513? PV for this. PV for this should be 0.7. PV for this should be 0.7. 0.73. 0.73. 0.7312. Thank you so much. And then the discounted cash flow will be equal to what? Discounted cash flows, you take this times this. Give me an answer. 15.43 times 0.7312. 1108.08. I'm so sure there are ninjas who use that 10.93. Yeah. So then this one here should be 1108. 1108.08. Thank you so much. Yeah, discounted cash flow. And then if you do it that way, what will be the final answer down here? What will be the final answer down here? No much difference. So then the farm value will be, you guys are really confusing me. You are really, really confusing me. Again, we're going back to 1291. Are we going back to 1291.37? We shall overcome. The good thing is that we have now understood this even much better. Wairimo and Olisa, how are they getting 0.11? Wairimo, I'm so sure today, Wairimo David, you must have come in late today, you ninja, because we did 11% in Roman 12 the question. So please, what I would recommend, Ninja David, please watch the video. I think that's fair enough. That's fair enough. That is fair enough. I think that's fair enough. Is that okay? Ninja David, is that okay? You watch the video, because I know when you ask that question that I've done up there and you're a sharp guy, I'm so sure you came in late today. You must have snoozed your alarm. All right. Then let's get to this question here that I want us to do as an exam. December 2022, yeah, alpha and beta. December 2022, question number 5C. Yeah. So the question here reads, required maximum exchange ratio that Alpha Limited should agree to if it expects no dilution in its post-acquisition EPS. Number 2, Alpha Limited's post-acquisition earnings per share if the companies agree on an offer price of 40. Note 3, Alpha Limited's post-acquisition earnings per share if for every 200 ordinary shares, of Beta Limited are exchanged for 5 years of 10% debenture or 500 per value. 4. Combined EBIT and the post-acquisition earnings per share at the point of indifference between earnings of the firm and the finances. So they want us to give them the indifference points. Great. So we are starting this an exam now. And in this class, I've never given any student mwalimu's jackpot. You know, very soon somebody will be able to get a jackpot. Especially if you're that student who keeps on helping others on WhatsApp group. Yeah, you are helping others. In this case here, when people ask questions there, you are answering them like that. I mean, like you're an assistant teacher. Very soon, you shall get my jackpot. And my jackpot is very good. You will never forget me in your entire lifetime. In your entire lifetime, you'll be saying this mwalimu taught me and they gave me a jackpot. Don't be remembering me because of FM. You'll be remembering me because of the jackpot. Yeah, 11 marks, yes. Oh, already have done this as an illustration. Wow. Wow. Are you sure? Are you sure that you have done it? Are you sure that you have done it? Let's see. And if you have done it, then Roman 4, the one of indifference points, I'm so sure we haven't done that part, which is very, very important for your exam. Yeah, somebody should be able to help Liaka. Looks familiar, eh? We haven't done part 4, yes. We haven't done part 4, but now the question will be, do you think you'll be able to do part 4 without repeating part 1, 2, 3? Yeah. Is there someone who can share this question with Mr. Liaka? On WhatsApp. On WhatsApp. Yeah, we left it halfway and we must finish. The last part we have to finish. We have to finish the last part. Yeah, actually the better thing is attempt the whole question. Attempt the whole question from the beginning. And then you put your answer far away. Don't look at the answers. Don't look at the answers. Just start doing this thing from scratch. And then you will come thanking me. You will come thanking me later on. You will come thanking me later on. So now you are doing the whole question. Now that I'm coming to the end of this topic. So my next topic, ladies and gentlemen, that I'm beginning tomorrow, is called reorganizations. Reorganizations, corporate reorganizations. When a corporation is going through turbulent times, they need what we call re-engineering. When a corporation, in these cases and gentlemen, is bankrupt, don't just leave it to disappear. No, we need to re-engineer it. So then I'll be able to show you like how do we measure bankruptcy. Yeah, and I would want on that note, if possible, come with your company's income statement and your company's balance sheet. You don't give it to me, but just have them, because I would want us to measure, first of all, the bankruptcy level of your own company. Does that mean that if you get it bankrupt, you need to go and tell your directors? No. You start making avenues? No. Or no. You'll think like an accountant. How do we make this company survive, thrive? Yeah. So I'll be able to show you very, very important areas like what we call Altman's Z-score model. Very good areas. That is why our tomorrow's class, nobody shall miss it. And it's a very short topic. I start like this and I'll be able to finish it. Like within that 1.5 hours, I'll be done. I'll be done. So then that is it, ladies and gentlemen. It has been a beautiful thing. I mean, sharing this particular knowledge with you this early morning. I'm looking forward to meeting you tomorrow. Finish doing your work, your homework, and if possible, take a screenshot, throw it on our WhatsApp, and we shall be happy. Have a lovely Sunday. Bye-bye. Great. Thank you. The same time, same time, same time, same time.